a $5,000 vehicle and have a squeaky clean.
What if you drive a Ferrari but you don't get speeding tickets?
Well,
that sounds like the best of all worlds.
Actually.
So, in general, if somebody calls up, what's the credit score below which you're probably not going to get a loan? I don't know if there's an absolute number, but if somebody calls you up and says this number, you would say, hey, listen, I'll work with you, but we got some challenges in front of us. Is it 500, 600?
580 to 620 is typically going to be the lower end of the spectrum on the majority of loan programs out there. I mean, there are some other loan options that are considered to be non-QM or non-qualified mortgage programs that allow for, recent events like foreclosure and, recent bankruptcies and things like that and lower credit profiles. But of course, anything outside the box like that with a little additional perceived risk is going to have a little bit additional premium. But to answer your question, I would typically say 580 to 620 is going to be the bottom end.
So I'm just curious, what's the lowest score you've seen?
Oh, I've seen it in the threes.
Wow.
Yeah.
You got to work pretty hard at that.
Yes, you do.
And on the flip side, what's the highest score that you've seen? Do you recall?
I want to say it was like an 825. I've never seen anything in the 830s or 840s, and this is going on 14 years.
And what do you think? Have you seen statistic? What's the average credit score for the average American adult? Do you have any idea?
I was just looking at that. God, I can't remember where I saw it, but I want to say it was in the low 700 range. And actually, the article that I read was that credit is actually at, I don't know if they said it was an all-time high or just a very high point in the average consumer.
Really?
For the average consumer, absolutely. I was surprised by it, but
that's interesting. All right, neat. Let's switch gears a little bit. So the real estate market, I mean, the mortgage industry, you're closely tied to the performance of the real estate, right? So if somebody's in a city, if you're a mortgage professional in a city that real estate is red hot, you're probably going to be busier than if you're in a state or a locality where the market is flat or declining or there's not a lot of economic vitality going on, right?
In theory, yeah.
So how has the mortgage market been impacted by increasing interest rates? So just to set the stage, listeners, you've heard me say this a lot. One of the big issues going on in this country in the economy is the fact that the Federal Reserve has embarked on a strategy to raise interest rates. They raised interest rates in late 2016 one time, right after the presidential election. The Federal Reserve raised interest rates 3 times in 2017. So far, as of this recording, which is mid-November 2018, they've raised interest rates 3 times already this year. And everyone, including yours truly, expects that they'll raise interest rates again in December, meaning that we will have had 8 rate hikes in about 25, 26 months. So my question to you, now that we're all caught up, is how has that affected the mortgage market?
I definitely feel like it has an impact because it impacts affordability. So if you're in an appreciating market where not only home values are going up, but interest rates are rising at the same time, it's kind of like a double-edged sword. It basically prices some people out of the market. Some of the people that are right on the fringe with that calculation, that debt to income calculation. So a quarter point, a half a point bump in interest rates, towards the higher end, could potentially mean the difference between you qualifying for a home that you really like in your price range versus not. So I mean, it's impacted the market. There are, again, always going to be people that relocate, whether it be for jobs or what have you, or downsizing or, expanding their families and what have you. So there's still real estate.
There's always things that are buying, selling, regardless of what's going on.
It does have an impact.
Understood. All right. Do you have an opinion? Do you think interest rates will continue to rise in 2019? What's your...
I mean, all the indications and all the indicators are yes, but my crystal ball stopped working today. So
yeah. I wish you would have brought it in.
I know.
I would have asked a whole different set of questions. But
yeah, if it was working, I would, be sitting on an island, somewhere owning it. But no, honestly, I mean, that's the indication. Ultimately, in the long run, though, if you look at, I'm 43 years old. I mean, I was around in the 80s when interest rates were 14, 15, 16%. So historically speaking, they're still very, very favorable. And I almost, to a point, feel like people have gotten spoiled over the last 3, 4, 5, 6 years.
Right.
Whenever interest rates were in the threes, so now they see an interest rate with a 5 in front of it instead of a 4 in front of it, and it's like, what the heck? But I mean, long story short, in the grand scheme of things, they're still very favorable.
Well said. So let me ask you this. Before the financial crisis, before, say, 2007, 2008 kind of time frame, I think it's well established that it was too easy to get a loan. That criteria, the 5 C's you've spoken about, became very, very lenient. Almost to the point where if you were able to breathe into a mirror, you were able to get a mortgage. And that led to some significant problems.
A pulse and a pen.
Yes. Yeah. And then it also seems to me that after the financial crisis, things got too strict.
Yes.
That we went from an environment where people who shouldn't get loans were getting loans on terms they shouldn't have gotten loans at, to after the financial crisis, there was almost this snapback, kind of the pendulum went too far the other way, and lending institutions were not giving loans that seem to have made sense, that they could have gotten good deals at good pricing with reasonable risk, and they weren't doing them. How do you characterize the mortgage market now? Is it too lenient, too strict? What's the trend been? Can you give me kind of your thoughts on that?
Yeah, I think it's coming back, and I to your point, I think you're absolutely right. I feel like pre-mortgage meltdown, it was like I equated to, I call it the credit belt. So like before the meltdown, like your belt was so loose, your pants were falling down, like, you know what I'm saying? But after, like, your belt was so tight, that credit belt was so tight, it was cutting off the circulations in your legs. So I feel like they're trying to find a happy medium right now. There are some products that are coming back that they're called non-QM or non-qualified mortgage programs that allow for self-employed borrowers that that don't necessarily, they take advantage of the legal tax code, and they take their allowable deductions and things like that, and so the money that's going into their account and that they make maybe isn't necessarily claimed on the tax returns as far as because of the deductions. So so there's a big pool of borrowers out there. That's good. That are now being able to be serviced, and we have products for that we didn't, a year or 2 or 3 back. So I feel like they're kind of loosening up and getting back to more common sense underwriting guidelines. That's
encouraging, because I know my view is another characterization of the post-financial crisis is that the mortgage market was very much a one-size-fits-all. If you checked the 10 boxes, you were good to go. And credit was still... But anything else was an enormous problem. And in a country as large as ours and as diverse as ours, with different entrepreneurs, people changing jobs, moving, they're just lending institutions, as governed by the regulatory bodies, they were just too stringent, too narrow. It wasn't enough flexibility. But it sounds like as we move farther from the financial crisis...
It was a snapback type thing. It's like we went from being too loosey-goosey to like now we're choking the whole credit box. So
all right, good.
I feel like
I like to hear that. That makes me feel really good. What do you think about technology? How is technology changing the mortgage industry? Since you've been in the industry, how is it changing it for you as the professional, but also making the mortgage process in some ways better for the borrower?
Yeah, technology is a big piece of where I think the mortgage industry is going. It's definitely providing efficiencies, which I feel is very needed in this industry. Frees up time. Millennials are a huge segment of the purchasing market now. So, being able to complete an application online and snap a picture of your documents and upload them to a PDF, or even type in your banking institution's user ID and passcode and have that data basically, instead of providing an actual paper statement, have that data drawn into
instead of bringing in like 97 statements from the last 3 months. It could be electronically transmitted.
Being able to access your electronic pay stubs from your payroll provider and things like that. So it's definitely providing some efficiencies, but in the long and short, this is still a relationship-based business. It's still a customer-centric, face-to-face communicate, and ultimately, hold your hand and walk you through the process, because it's a huge thing. It's a lot of money, and you need
and it's a stressful experience when you're buying a house. There's a lot of money involved. There's a lot that's going on, not just with the mortgage process, but moving.
Of course,
it's just an enormous undertaking.
Yeah.
Even if you've been through it before, it's an enormous undertaking. Yeah. So working with somebody that could alleviate the stress, make it easy, help you overcome bumps that might come up with, getting this document or verifying this piece of information. So that's neat about technology, because I think financial industry in general, including my segment of that world, is being driven a lot by technology, just like yours. That's why I wanted to ask. So usually with guests, I ask, not knowing a ton about your background, but, given where you are, younger father, professional, over time, have you developed any rules of money, things that are guiding principles for you and your wife as you try and achieve your own personal financial goals? Can you think of any rules that you guys stick to?
I wish I had something like that put in place, but I guess that's where the professionals like yourself come into play, helping people manage their money and making sure they're doing the right thing with it. But I could use an education when it comes to that piece.
Sounds like a business opportunity for me and Elliott Wealth Management. By the way, that was not a setup. I asked that completely off the cuff. I don't think he was expecting that question. But listen, guys, thanks very much for listening. You could get more information about me and Elliott Wealth Management services by going to our website, www.elliottwealth.com. Please subscribe to this podcast. You could sign up for our mailing address. And if you're like Jeremy and might need a consultation, we offer no-cost initial consultation where we could talk to you about your goals, objectives, how we could help you win with money. I also want to say that if you're interested in learning more about how getting a mortgage might help you, if you're looking for your first home, second home, trading up in home, if you're interested in getting information, Jeremy is terrific. There are lots of professionals out there. But Jeremy, if someone wanted to speak with you, how would they get in touch with you?
Yeah, absolutely. So my best contact is my cell phone number, which is 860-478-2957. I could also be reached via email at jhyatt, JHYATT, at Envoy Mortgage, ENVOY, or my website, which is HyattLendingGroup.com, HyattGroup.com.
Great. Thank you, Jeremy, for joining me.
My pleasure.
I appreciate it. I will see you soon.
Absolutely. Thank you.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.
Simply Financial is part of the Exvadio Podcast Network. You can find Exvadio podcasts at exvadio.com/podcast, the Apple Podcasts app, iTunes Store, iHeartRadio app, Spotify, Stitcher, and wherever you find podcasts. So join us and stay informed and entertained.